What's up, guys? Welcome to a new video. My name is Joop from the Clips, aka Macaroni with the Cheese. Every day I try to make some videos about the financial market, about stocks, about crypto, and today I got a brand new video for you guys. I'm basically gonna reply of the things this guy is basically gonna telling us. His name is Nouriel Rubini. He's basically a researcher on the financial market. He has a few years in this domain, and he's basically warning us about the crashes which coming. Let's be real, we pretty are in an obvious difficult time with inflation rate is pretty much high. Interest rates is high because the Fed is trying to fight the inflation rate. Inflation rate is basically been sticky around 3.2, and this guy is suggesting that it will stay around, and he got a few notes for us. And further in this video I will share with you guys what basically the main reason for this video is that there's gonna happen a credit crunch, but I will explain more about this in the video. Let's watch.
This seems to be something that's incredibly elementary. Your incoming freshmen at NYU already know that when rates go up, when the yield rises, the price of the bond assets falls. Is that the simplest explanation for what happened in terms of the banking crisis here in the US? And were these just idiosyncratic problems with bank managers that didn't know what they were doing?
Yes, it's a good part of it. Both bank managers, regulators, and investors forgot about duration risk and market risk. When yields are higher, the price of the bonds is lower. Investors lost 20% last year on 10-year treasuries. The S&P 500 went down only by 15%. And for the overall U.S. banks, you have about $620 billion of unrealized losses on the securities out of a capital of $2.2 trillion. And for some of the regional banks, the number are much higher. But it's not just the securities have lower value. Many of the banks had issued loans like mortgages at fixed rates at 30%, 30 years, when interest rates were 1%, while right now there are 3.5 for 10-year treasuries. So the market value of those assets is also down. People have estimated, therefore, the overall losses for the U.S. banking system for the rise in interest rates, both on securities and loans, are equivalent to 1.8 trillion out of a capital of 2.2 trillion. Hundreds of the smaller banks are literally insolvent. So that's the fundamental problem. When interest rates go higher, the value of securities and loans is lower, and then we have mass liquidity and solvency problems.
He's basically saying that the banks are insolvent. They basically have a lot of debt. They don't have the money, so they basically are drowning. They have assets worth of 2.3 trillion, and most of the assets are in debt credit. So the assets they are being given and shared with those peoples are basically underwater. But let's continue.
That's 10 dangerous trends that imperil our future, and I wonder if this is among them. Interest rates at 5% or even 6% don't seem like a mega threat. We've had rates as high as 20% in recent history, in the early 80s, but we have so much more debt now than we did back then, which means carrying costs are much more painful. Is this higher rate regime a mega threat, Nouriel?
It is, because in the 1970s, when we had the stagflationary shock that led to inflation and recession, debt ratios in advanced economies were only 100% of GDP, private and public debt. Today there are 420. So we have the worst of the 70s in terms of negative supply shock, reduced growth and cause inflation, and we have debt ratios that are much higher than after the GFC crisis. And during the GFC crisis, we had the debt problem, housing debt, mortgages, bank debt, but we had negative demand shocks and a credit crunch that led to deflation, so we could do massive monetary, fiscal, and credit easing. Now we're entering a recession and financial instability, having to raise interest rates because the inflation is too high. So we get inconsistency and a trilemma. We cannot achieve price stability, maintain economic growth, have financial stability at the same time. So eventually we'll have an economic and financial crash.
So eventually we'll have a financial crash. There's not economically stability, price stability. Man, there's a lot going on, guys. You gotta be sure. But let's continue. So you got more. We got more. We're not ready. We're not ready. Let's go.
I mean, central banks say they can do those two things. Good morning to you, Muriel. They say that they can have financial stability and they can control monetary policy because they're different levers dealing with different problems. You doubt that?
Yeah, there's this separation principle that says we're going to use the interest rate policy for price stability, and we're going to use liquidity to backstop the financial system and have financial stability. But that occurs only when the problems of the financial system are purely liquidity and limited to individual institutions. When you have a systemic problem and there is a risk of insolvency, and by the way, an economic recession is going to lead us from duration and market risk to credit risk, you cannot essentially lose liquidity support of the banks as a way of backstopping the system, and there's an inconsistency between price stability and financial stability. And we're headed towards a hard landing, a credit crunch, and significant amounts of losses, both for debtors that are facing much higher nominal and real rates, but also for savers and creditors, because the rise in interest rates reduces the market value of their creditors' assets. So you have financial instability, price instability, and economic instability.
Nuri, you used the phrase credit crunch, and we all threw around the term credit crisis in the late 2000s. We know that that led to the financial crisis and everything that followed. How bad do you think this credit crunch gets this time around? We heard the Fed uncertain, and many voices uncertain about how much we see a pullback in the offering of credit.
Well, most of the financing to SMEs and to households in the US occurs not from the large money center banks, but from these regional banks. And these regional banks are in trouble. There is deposit flight, there are uninsured deposits, there are fundamental security losses. There'll be a tightening of credit and credit standards. They have to be more cautious, they'll have to raise capital, so they're going to lend more. Credit growth is going to probably go from 10% annualized to closer to zero, and therefore a good chunk of Main Street and Middle America is going to be subject to a significant credit crunch that's going to exacerbate the risk of a harder landing of the real economy.
There's basically not money anymore to be lending, because most of the people there lending their money from the regional banks, but the regional banks are basically insolvent. They don't have any money anymore to lend. So that will develop in a financial crisis, in a recession. So this is basically what I was telling you guys. And the main word that he's mentioned was the credit crunch. There's basically no more credit. We got to crunch it. So with saying this, I would like to share this post of James Chow. And in this post, he's basically explaining what's basically happening. He's telling that investors are basically creating a pump phase where there is a terrible economic. Well, there is the terrible economic. Printing is coming back, easy money gain, and let's front running. During this phase, however, institutional investors are trying to pass their risk asset to retail investors. The most of you out here reading this. So let's see what James Choi is telling us right now. So I'm gonna make this a bit bigger for you guys. This is where we at. The blue line is the expected, and he's basically telling us that we could see a credit crunch coming in the next few weeks. So mid-September. Today is Sunday, the 3rd September 2023. He's basically telling us that we could have a credit crunch, and with the credit crunch is coming, the risky asset will be coming down. So that's what he's predicting. I'm not sure about it, but it's very obvious. It's very a nice explanation what he thinks it will be going on. So be prepared, guys. Be prepared. But so what is he saying? He's saying that this is the QQQ, by the way. He's saying that it will rise until the 400, and then it will come down because of the credit event that will be going on. And it's basically what Nuriel has been telling in this video. The banks are pretty much insolvent. They don't have money anymore. There's a financial crisis, inflation. Economically, it's not going pretty well with the United States. So, and overall, they're trying to create a new world order. They try to create a reset, the Great Reset. So there's a lot going on. But before they try to do that, they basically are trying to save their money. And I do think that this is something that could happen. So keep that in mind. Okay, My next subject is also something I want to share with you guys. Is basically the DXY. The DXY is basically a good indicator of how everything is going with the stocks market. If we have a strong DXY, that means the stocks market is going down. If we have a weak DXY, a weak dollar, that means the stocks is going up. What do we see here? It's basically a wick of accumulation. And this guy is telling us that in the next few weeks, we could see a rise of the DXY. So the DXY is currently at a price of 104 to be exact. Yeah, 104, and he's basically, we had a critical point at 103, and we passed that already. And I will put it on a monthly. Back in September last year, we had a DXY, a strong US dollar, and 114, and that was basically the lowest point for last year when the stocks were down. But we could see that in the next few weeks that the dollar will go up. As you can see, it will go up. And then when the dollar was coming up, that will mean the stocks were coming down. So this is a good scenario also to rethink what's basically going to happen. And that's something I want to share with you guys. So be prepared, do your due diligence. It's not financial advice, but that's basically the main reason why I want to make this video with you guys. Okay, so the next subject is Apple. I'm a big Apple fan. I always liked Apple, but I have to be very careful and always try to do my research on this company because they are making moves. It's the #1 asset in the world, as I always try to share and always try to be very transparent. It's a 2.9 trillion market cap company. Second on the world. The first one is gotta be God's money. That's gold. Third one is Microsoft, and don't forget Amazon, Google. But for now, they are bringing out the new iPhone 15, and we got a date. We got a date, guys. It's gonna be on the 12th September this month, basically over 9 days. And in my previous videos, I shared with you guys that I'm basically gonna short this movement. I'm gonna short the Apple stock. So be prepared. In 9 days, historically, share price always went up for at least 10%. And I was telling you guys that I'm basically gonna short the Apple stock. So what is the price of the Apple stock at this moment? It is 189.46, and I'm basically gonna short it. As you can see, it had a top of 198. It went down, retested at let me make it on the daily, retested on 171, around 171. Yeah, 171, 172, and it retested, and now we're coming back because in the next few days, let me see, the next few days, on a Tuesday, this day, there's gonna be the new Apple 15. So historically, they always have made some good numbers. Next event in Apple's calendar is iPhone 15 launched on September 12th. This is now official following the sending out of invitation near the end of August. At least the event is official. The announcement themselves will remain secret until the last possible moment, and Apple is referring to the event by the title One Deluxe rather than iPhone 15 launch. So I already told you guys that I'm a short display. I bought some shares, and basically that's the move that I'm gonna do. So for the overall market, I'm gonna share some stocks with you guys. I bought some ENTC. That's what I did. And let me put it on a weekly. I bought some ENTC. I pretty much like this stock. AMD is doing well. AMD is doing well. And Tesla was coming down. BABA, I do have some stocks of Baba, but we got to be aware with all things that be happening in China with Evergrande. But I do think that China will continue to quantitative easing. So, but it also have a lot of influence on the U.S. market. So you got to be aware of that. Splunk, because I'm in cybersecurity, I like Splunk. I do want to buy me some more Splunk stocks, but let's get to the big boy, Tesla. I also expanded my position in the ETF, Vanguard ETF. But let's go to the big boy, Tesla. Where we at? So Tesla has been coming down lately. It's been coming down since 300 brows, and we been back to 212. Now it went up to 260 again, and now we are coming down to retest some other levels downstairs. We even could see 200. If it reached 200 a price, I'm gonna buy some more Tesla stocks, but we gotta consider what's going on in the market, so be prepared. So what do we got going on in the next few days for the stock market? On 3rd September, we got inflation numbers coming, and CPI is coming. So that are basically important dates. For this week is not very an important week, but the week upcoming, so the week of 12 and 13 September is gonna be, it's in the same week when Apple is gonna launch their iPhone 15. It's gonna be a special week to watch out. Inflation numbers coming, and it's gonna be a very critical day. And be prepared. Keep in mind that September, it's overall a down month for stocks, so be aware of that. So basically, I'm in the end of my video. Thank you guys for watching. If you like this video, subscribe. Also subscribe on my YouTube channel and subscribe on my Twitter. I basically share everything that I want with you guys. And yeah, I will see you guys in the next video. Bang bang. Peace.